Hello and welcome to Amati Insights. As you know, we do this calls every 2 weeks, and we try to focus on things where we have strong opinions, where we think investors really should care about these things and should know about our views on these things. But of course, at no point this is a recommendation to buy or sell any security or fund. And there's a disclaimer on your screen at this point illustrating that. It's also available on our website. But with that, we are approaching summer. We will break for a little summer break. As far as insights are concerned, of course, we will be working hard ourselves. We will return in September. So this is an opportunity to maybe summarize what's been happening in the past 6 to 12 months in our asset classes and our markets. But also talk about things that we're most interested in, we're working on hardest going forward. So we've got representatives from all three of our strategies. So Paul Jourdan from the UK Smaller Companies side, Georges Lequime from the Strategic Metals, and myself from the Amati Global Innovation Strategy. So with that, over to you, Paul, to moderate.
Yeah, no, thanks, Mikhail. And I think we're in a very interesting and actually quite difficult moment in markets. Right? If you just imagine yourself in the position of first-time investor, where are you going to put your money? It's pretty complicated. And obviously, one of the big themes of the year and major factors of the year that's driven markets all over the place has been AI. And your fund, Mikhail, is that's kind of absolutely central, and it's driven great successes and great failures and drawdowns of capital the other way, some extreme situations on both fronts. How have you handled all of this, and what are you making of it?
Yeah, well, we always took a view that there's more to innovation than AI, but AI obviously has been a remarkable growth driver for the semiconductor technology space in general, but also some adjacencies. And I'd say if I were to pick one observation that surprised us, that feels really important for us to mention, is how polarized the market has become in judging the winners and losers of AI. We'll show you a chart highlighting the difference between the semiconductor stocks performance and software stocks performance, the perceived kind of winner camp and loser camp from AI change. These are dramatic divergences in performance. And so the magnitude of the divergence and the single-minded focus that investors have on this theme, almost to the detriment of all other areas of the market, is really interesting to us. And we see signs of unquestioning optimism regarding some of this. And people cite example of SpaceX valuation on the recent IPO, where most of the value is AI that is yet to come, some of it in space, but it's we can't complain because we benefited in our portfolio, as you mentioned, from memory semiconductors and photonics. Both are key enabling sectors for AI growth, and the importance of the sectors market has appreciated a lot more, and very much so over the past year. Now, these are profitable, cash-generative businesses. We think valuations are justified by their much improved fundamentals, but we have to be honest with ourselves and realize some of this unquestioning enthusiasm bordering on irrational exuberance. Yes, it bid up SpaceX share price, but it also contributed to the run-up to our stocks. So that's kind of looking backwards what we would highlight as the definitive feature of this market. Going forward, we continue this view that there's more to life than AI. AI is very important. It remains an important strand of our research. But actually, we're really interested in digging through the rubble in the AI losers, so specifically software and IT services, and the evolving role and what is their resilience as enterprises adopt AI tools. The market's simplistic assumption is that AI eventually disrupts and disintermediates these business models. We think that's too simplistic and possibly wrong. And the interesting thing for us is companies are adamant that AI creates an opportunity for them, both in sales growth and in margin. And they don't just say this in investor communications; they also say it in industry events, to their peers, to their customers, where they don't have an equity story to sell. So it's very intriguing and almost, in my career, unusual divergence between the industry reality and the market narrative. Mm-hmm. So that's one area we're digging in more. The other thing, which is a little bit AI adjacent but quite different, is what we would call sensor proliferation. So, we may or may not get artificial superior intelligence solving all our problems. We're not making that bet. But we know that all the machines are getting smarter. Some call it edge AI, some call it physical AI, edge AI, like AI on the edge. But it's everything from factory equipment to robotics, to military drones, to passenger cars. As these devices becoming smarter, they need more They need to see more. They need to hear more. We call it a sensory development, if you like. How do we position ourselves, for the supply chain that makes these machines see and hear things? That's another area we're digging into quite strongly. And the third one I'd highlight, we haven't really seen any evidence of that on the macro level beyond data center boom, but there are straws in the wind that the kind of industrial capital spending recovery in developed markets is coming back. And with this reshoring, rebuilding of strategic industrial capital, it's happening in the markets where the availability of labor and the cost of labor are very different from where they are in China, for example, or where they were 20 years ago when this industry moved to China. And so, as we think about this industry being rebuilt in the West or reindustrialized in the West, the way this capital will be spent will be very different. Robotics, automation, machine vision, additive manufacturing, or 3D printing, as some people call it. These are more advanced, accessible technologies now, and we'll think. We need to understand who are the relative winners in that kind of reindustrialization will be. So these are, if you like, our summer homework projects that we will be working very hard over the next months.
Fantastic, thank you, Mikhail. And George, it's been quite a wild ride in the commodities markets this year, and gold had a massive high in January and has been trickling away a bit since then, and lots of other commodities have been, silver especially, even had this huge cycle. How are you handling that, and what do you see as the prospects for the next 6 months?
Yes, Paul, it's certainly has been a bit of a roller coaster, and I think until the 28th of February, when the US-Iran conflict began. So we through last year and sort of into the beginning of this year, the premise was more rate cuts through 2026 and 2027, and that's what really drove the record highs that we saw. And then after the start of the conflict, the US-Iran conflict, inflationary pressures from the ensuing global energy crisis has really been forcing global central banks to reconfigure their policies. And as you said, we've seen a retracement of some 25-27% in gold prices and just a little over 50% in silver prices. And these kind of retracements are not unusual, but it does shake confidence in the sector. Initially, we did get some restricted metal flows and a reduction in foreign exchange generation in the Middle East, so that negatively affected silver and gold demand, a direct result of the conflict. And remember, the central bank buying has really been the foundation of the rally we've seen in the past few years. And then gold was really being used as a liquidity by both sovereigns and investors alike to cover losses elsewhere. So, as you mentioned, this constant on-off peace deal is causing more volatility across the metals, and investors are just sitting back and unsure where to go from here. And then the last week or so, we had the first FOMC meeting by the new Fed chairman, Kevin Walsh, and he seemed to adopt a more hawkish tone, which sent the dollar up in a melt-up trajectory, really, which has put pressure on commodities across the board. So, Paul, we've many times we point to the fundamental drivers for all the metals, which we believe are still very much unchanged. We've still got supply and demand imbalances. It still points to higher prices in the medium to longer term. But I think in this kind of environment, the market is looking for catalysts that will turn sentiment around. And it's quite simple to say, well, metal prices look oversold right now, and we know valuations are probably as cheap as they've ever been. But we're waiting for some kind of metal price stability right now, and the peace and the monetary policy certainty. And I think we need that before investors are going to return to the sector in a big way. So for us, it's very difficult to react day by day to developments in the Middle East and what the potential impact will be on metal prices. And what we've been doing is just quietly solidifying the fund's investment in world-class assets across the spectrum. We really focus on the quality of the company's underlying assets. We love the relative valuation arguments, and we see a number of companies with very, very strong free cash flow generation, even at reduced metal prices we see right now. And we do have a preference for very high growth companies because we're going to see production growth of between 20 and 100% production growth over the next 3 years. And that's going to drive down costs and will ultimately drive up the value of these businesses going forward, even in a flat to lower price environment. So I think the longer term picture, medium to longer term picture is very, very much in place. We saw the sector really underperform for 14-15 years from about 2011 onwards, underperformed the broader market, and that recovery really started at the beginning of 2025. And we've seen in any recovery we're not going to get a straight line. We're going to get sort of bumps along the way, but I think just the fact that there's the quality of the financial performance of the sector and the strong balance sheets, as well as the fact that they're trading on such low multiples, I think this will stimulate some demand for the metal stocks in the short to medium term. So we're still positive, but we're just finding this is a time that gives us an opportunity to increase our holdings in really good companies.
Yeah, no, thanks. And then from the UK point of view, I think we're for the most part on the other side of the capital flows here. That AI has been mostly an American phenomenon. The hot stocks, if you like, are mostly the American mega caps, and SpaceX is very much case in point. $80 billion flowed into the US. Where did that come from? Some of it came from the UK market, undoubtedly. That's also true of all of the other, the major AI companies. And I suppose we're in one of those moments in the market where there's a really strong consensus that money wants to be in AI, irrespective of valuation, irrespective of how speculative it might be, irrespective of how little we really know about what's actually going to happen next, other than we know AI is going to be used a lot, but at what tempo, who's going to really make money from it, where are the real sort of value points in it, how much of this capex that's going on is going to produce returns. It's speculative. We don't know. Meanwhile, in the UK, the money's sort of drained away, so we've got this market where the tide's out, effectively, and we've got, I think, a fantastic set of companies. One or two of them have got really good AI sort of credentials. The market reckons some of them are AI losers, even though actually most investors in those companies don't. And we actually think that most incumbent businesses are going to find their way of negotiating around AI and use it well. The well-managed companies will benefit from it in general. And we've just got this extreme sort of value and for growth companies. It's that you can buy. We're just looking at them thinking we can buy these at great prices. We're here to do that. That's our business. It's a bit of a sweet shop in a way, the UK market, but it's one that not many kids are coming in to buy the sweets because they're being drawn to the AI sector, and there they don't mind what they taste like, or they just want them because they're AI. We're feeling very optimistic about the companies we're investing in, but they're suffering from the market, suffering from capital outflow, and that of course then leads us on to what's going to change it. And I couldn't really finish this without some mention of the change of prime minister in the country. Like most things, like the war in Iran, like AI, we're at a point where we don't know what this is going to feel like. I would love to be optimistic about what's going to happen. I think Andy Burnham has an incredible opportunity to reset things, and it wouldn't be difficult to do in the UK. There are great opportunities in our market, and in the country, but some things need fixing, and the question is he going to fix them? And they take courage to fix. They take political capital to fix. That nobody's pretending this is an easy job, but it's certainly a possible job. And I'm really hoping come September, when we know what the shape of this is going to look like, that we're all feeling very good about it. I if I had to set a probability on that, I honestly don't know. I mean, I've read conflicting things. I think he's a very smart man. A lot's going to depend on appointing good advisors around him, as with any prime minister. They can only really be as good as the team they build around them. And there are many pitfalls. Just one quick story to relay. There was a broker put on a conference and recently, and Ed Balls came along and was speaking, and someone asked him, well, who's going to be the next chancellor? He said, oh, I think it's probably going to be Ed Miliband. And there was literally a gasp in the room, reportedly, and then nobody said anything, and nobody wanted to kind of follow up on it. And eventually somebody did follow up on it and say, Ed, did you hear that gasp? And that really means something. And clearly, it's not just the city that doesn't want Ed Miliband as the chancellor. There's many of the unions have come out and said they don't want this. And so there's some really obvious mistakes he can make, and it'd be very easy to point Ed Miliband because he's so powerful in the party. But it would be it would be taken very badly if he did that. We clearly have to sort out our energy policy in the UK. We have to address the size of the benefits bill and so on. But I've also read things that Andy Burnham knows that and he wants to tackle them. So if those two things on their own, tackling those two things would change a great deal, and it could happen really quickly. So we think there is a good opportunity here. We're in an unloved asset class. We know that. We're testing everybody's patience, but actually I'm quietly very confident about the way this should work out. So let's see how this plays out in the second half of the year.
Great. I mean, my operating assumption is that in the long run you make money by being in undiscovered gems in unloved asset classes, which makes this an interesting positioning, and makes our job in the innovation space a bit harder, because we have to dance around some very hot areas to make sure we're not just joining a crowd of cheerleaders and finding some original ideas, which we have managed to do so far. But we'll be working hard on that. All of us will be working hard on that over the next months, and we will speak to you again in September when this calls return, and look forward to that. Enjoy your summer.
Thanks.
Thanks.